Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Hey everyone, and welcome to the Bucket Plan on Demand. I'm your host, Dave Alison, and we have a very special guest with us today. We have Ed Slott. I think everybody on this podcast knows Ed Slott. If you're an advisor, if you don't, maybe you've been living under a rock for the last 20 years. Ed is America's IRA expert. He is a nationally recognized expert on IRAs and IRA distribution planning, retirement tax strategies, and he's been very well known for making complex topics accessible and actionable when it comes to IRA planning. Ed is the founder of Ed Slott and Company, a leading provider of IRA education and training for financial professionals. He's the creator of the Elite IRA Advisor Group. He is a best-selling author and popular media personality. And Ed has helped millions of Americans and their advisors maximize their retirement savings. I don't think there is anybody else in the financial services industry that has done more for education and planning for advisors around IRAs than Ed. What he's created with Ed Slott and Company and the Elite IRA Advisor Group is something incredible. I know Ed will be out in Atlanta next week. Right. And you've got your elite group going on there. And I'd love, before we get into some of the technical components, today's topic is going to be defusing the retirement tax time bomb. We can talk about where you came up with that name in a little bit, but maybe share a little bit of background. I mean, when did you become a CPA? Let's go way back.
Oh gosh. Well, me and Moses were climbing up and I got the tablets, and all of a sudden I was a CPA. It was a long time ago, but a few years after school, after like my first accounting job, I'd say in the late 70s, early 80s, somewhere around there. So it's over 40 years, that's for sure. CPA, the landscape was different then. Most people that are not my age would have no idea what we used to do as CPAs. I'll give you an example. We used to go actually travel to clients. This is one thing that I'm glad I did, because I learned about relationships and communicating with people, because you saw clients every month. You went to their place of business, their shop, their factory, everything. You saw there were places where I sat on benches or rolls of carpet in a carpet store, and you'd take out the books and write up their checks and disbursements and receipts and do bank reconciliations. So you developed a very serious relationship with them. They were like family, the kind of funeral and wedding type relationships. Any event in your life, they came, I came to theirs. There was nothing like it, because you had that one-on-one. You're talking, hands-on. And that gave me a great education on how to evaluate a business. Were they making money? What were the problems? And the clients love that. You built relationships. So for that alone, the old school stuff, it just showed you how to build serious relationships with in-person communication, which virtually doesn't even exist now. So that's where I started. But I realized early on that this was great. You made money, and eventually I went on my own, and we were getting the monthly fees, $50, $100, $200, $300 a month from a client, and a few $100 for tax returns. And I realized, now I'm just trading. And luckily I realized this in my late 20s, early 30s. I was just trading time for money. And, there was no scaling. That wasn't even a thing. You just did your job. You were a regular accountant and got a check. And then I said to myself, no, I got to be able to provide higher value, because if you're selling, and this is truth now, if you're selling on price or performance, I didn't sell on performance because I've never done any products, stocks, bonds, funds, insurance, annuities, none of that. So basically, you were selling on value, but it was also, they knew what their other business owner friends paid their accountants, and it was always in the range. And I said, this is not a long-term future. Luckily, I realized that while I was very young. And I said, I got to do something that provides high value. And that's everything I'm saying is true today for advisors watching. There's a lot of fee compression. That's the big word in the last few years, fee compression. How do I get more fees? Well, deserve it, earn it. I mean, provide value, tangible, quantifiable value. And I realized it's not so much doing the books or the taxes, because all I was doing was recording history, things that already happened that I couldn't really change because I was looking backwards. So it hit me one day, I got to look forward and do planning where I can make a difference and charge higher fees for the value I bring to the table. And I realized back then, I said, I joined my state society of CPAs to connect with other sole practitioners. I was on my own at that point, early 30s. So I started out doing seminars. I switched. So I said, I could get this out to people. I mean, people are starting to build 401ks and IRAs, and they're going to need this estate planning and tax planning. So I started out doing these little seminars. I did them every month with an attorney friend of mine. He did the attorney, the wills and trusts and all that, and I did the tax planning. We'd get a few people, but we were consistent. We did 3 or 4 every month, and it cost us a lot of money. There was no online, so the only way you can advertise them is in the local newspaper. For me, that was Newsday in Long Island. And little by little, through consistency over time, we were getting 100, 200 people at every seminar, 3, 4 times a month. But what I loved about it, I was getting clients, not a lot, but a few each time, at much higher fees. And what I would love, because I position myself as a specialist in this area, and people knew they needed a specialist. And my favorite comment in these little seminars was when people would come out and they said, Ed, I already have an accountant, but he's just a regular accountant. I think I need a special. Oh, yes, you do, and you're going to pay for it. And they say, okay, people, what I learned is people want to pay for value received, and that's always the way. Once they see value is here and the price is here, that's the differential. Then they want to pay for the value. That's what value is. When what you're getting is perceived to be a lot more than what you're paying. And I put high fees on that. Not originally, because I was testing the waters. What I did, which was pretty good, because people were, a little into, they want to come back to an appointment. I said, you know what? I'm going to charge anybody in this room that comes to see me $1,000. I don't care if you have 10 million or 3 million. I'll do a plan. I wrote the things out by hand. And years later, people would come back and they said, this is the best investment I ever made, because they would come back for follow-ups. And you have to focus on what you're bringing to the table. Do you deserve it? Do you earn it? And the way to do that is get yourself educated to do the kind of planning which can still be done today. And this is what I love about tax planning. It's not speculative like the market. Oh, I can make you money in the market. Well, maybe not. Look what happened. But with tax planning, it's tangible. The results are quantifiable.
100%. Ed, I've picked up so much from you over the last, probably 10 or 12 years of, me following your stuff. And to your point, you need the education, you need the wisdom, which is why I think what you've done with the Elite IRA Advisor Group is just exceptional in our industry for an advisor to plug in and tap into not only yourself, but your team of technical experts that you have. But I always remember something you said, somebody asked you, they said, Ed, how do you charge? And you said, I charge $500 a question. What's your next question? Here's the where that comes full circle is it's the wisdom. It's not the time you put into it. To your point, you saved somebody millions of dollars in 5 minutes. That doesn't mean you should get paid for 5 minutes of work. That means you should get paid for the 20 years of wisdom that you built prior to that saved them that money. And I think that's what I know it's C2P. We have a lot of advisors that have been in the Elite program for decade, 15 years. And it's that cumulative wisdom that makes these people so valuable. Just on our last episode of Bucket Plan on Demand last week, we had a mutual friend in Dave Buchwald on as our guest. And Dave, he was talking about the story of finding you. And right when he heard these words coming out of your mouth 20 years ago, he was just all in as one of the charter members. And he was talking about the value it's brought to his business and how they differentiate themselves and how it's led to, an enormous business that they have at One Team Financial now. So, I know we're going to get into some current topics. I think what you just shared, though, is almost as if not more important than everything we're going to get about, like with outlook of tax code and policy changes and IRAs. It's number one, relationships, what you started off with, right? Going out, being belly to belly with people in their business, or if they're not a business owner, learning about what's going on in their financial lives, their family dynamic, their goals, their objectives. It's having the wisdom of how we can bring true value. No, I've seen, and I had a similar story I tell when I teach the tax management journey. For me, it wasn't the Tax Act of 86. It was 2017. For me, that was where the light bulb went off when I was reading through the Tax Cuts and Jobs Act, just being like, if I could get ahead of this as an advisor and learn how I can bring enormous value to the clients in our area that aren't getting this type of proactive advice from their CPA, I have an opportunity to build a very substantial financial services business. And that's what we've done over the last 5, 6, 7 years. But it was the same exact kind of aha moment that you had back then. Now, you've done a lot in terms of, like I mentioned, building the elite program for advisors and, obviously educating through PBS and all your books and everything else that you do. But I guess let's kind of transition into, the title of Defusing the Retirement Tax Time Bomb. I mean, talk about how you came up with that, why you came up with that, how you have this type of conversation with clients. I mean, it's interesting to think as America's IRA expert is also calling this thing something kind of negative, a tax time bomb.
Now my message ever since the Secure Act, that was the next big hit after the Tax Cuts and Jobs Act. And I've noticed one thing over time. I say this in a lot of seminars. After studying tax laws for over 40 years, there's one thing that's always been a constant. Whenever Congress names a new tax law, you can almost always bet that whatever they name it, it will do exactly the opposite. Like the the Reconciliation Act. How's that?
Inflation. How about the Inflation Reduction Act, right? Before historic inflation hits.
Right. So when I saw the Secure Act, they said it's coming out. This came out in actually late in 2019 for 2020. And I said, a Secure Act, oh boy, hold on to your wallets. What's in this? Just like you said with the Tax Cuts and Jobs Act, you look into it, and it was a massive game changer. And that one event made IRAs now the worst possible asset to own and to pass on to use for wealth transfer or estate planning. Now, we used to use that big asset for all the planning. And we told clients, advisors who told their clients to do that because of something called the stretch IRA, which came out of those 86 regs and the 2001 final regs and all of that, where a beneficiary could defer out, depending on their age, for 30, 40, 50, 60, 70 years if they were a 10-year-old. So that big accumulation and the deferral of taxes was a big benefit. So IRAs, as crappy as they were to work with, and they were always hard to work with because of the tax laws, the changes, the beneficiaries, the rules, who gets the stretch IRA, who's a designated beneficiary, do you have beneficiaries, how trusts work. You had to go through this obstacle course of tax landmines to get there, but you did it because it was worth it for the tax deferral and the buildup over 30, 40, literally decades, if not generations. But that all stopped with the Secure Act. And that gave me another light bulb moment because I realized now these are the worst assets on earth because they're loaded with tax, and all of that tax will have to be paid in a shorter window. For most people, within 10 years after death when it passes to a non-spouse beneficiary, like a child or a grandchild, for example. So once you push all of that taxable amount, and remember, by this time, all of these accounts for many of your clients, and a lot of people have grown to hundreds of thousands or not, or millions. And now all of that tax will be pushed in almost like a fire hose effect. And they're going to be wiped out. I call that the time bomb in taxes in one fell swoop. Now, that was the case even before the Secure Act, but you could stretch it out. So you could defer it and smooth out the tax bill over 50 years, the eventual tax bill. Now, that's not the case. So you have to do something about it. And that's why I named my newest book, The Retirement Savings Time Bomb Ticks Louder, because it's coming. I'm worried about future higher tax rates. In fact, I know we're recording this, but I'll have to date stamp it. Today's May 9th, 2025. And this morning I was reading in the Wall Street Journal, and now they're still crafting a tax bill. So IRAs, the big picture planning is to bring these balances down and get rid of these IRAs while rates are rock bottom low. I keep our tax chart. You get these as a member of our elite group. And everybody should, we just do it a little nicer so it has everything you need on one page. But it's basically the tax tables. Everybody watching this should have these tax tables, and you can get them from the IRS. They're everywhere. We just have a nicer a portrayal of them because we have everything on one page. I just had this situation with a friend of mine from years ago, and his wife is, I was helping his wife. She's turning 70, and she said, well, I've been retired, and for years, she wants to buy a home now and take from her IRA. So she says, for years, I haven't paid taxes at all because all I had was Social Security. I said, you haven't paid taxes at all and you have a $500,000 IRA? Why weren't you taking that money out? That's a federal tax crime. You were not, nobody, I wasn't her accountant. She had somebody else. Again, I'm not doing that anymore, but you called for advice, maybe a second opinion. I said, you had all these years in your 60s. You could have been taking this out at 10, 12, 20. You blow these lower rates. Well, now start taking it out while the rates are still here. She needed it for a house, but maybe she could have put it in a Roth IRA all of those years. So that's the key point, the takeaway for this. Do not waste these low brackets. We don't know how long they'll be here. Now, I do believe most of the framework, the tax cuts will be extended because they have the majorities in the House, the Senate, and the White House. And they should be pounced on. Anybody wasting 12%, 22%. I know I have CPA colleagues. They like to say, oh, Ed, I kept my client in the 0% bracket. I say, I'm sorry to hear that. You really blew it. I mean, you have an IRA and you're not using these low rates. And that's the way to bring these balances down. And it goes back to one of my always rules, the foundational principle of always saving the most money in taxes. And it's so simple, unless you're short-sighted, like unfortunately a lot of my colleagues are, because CPAs don't like to see their clients pay taxes up front. And the always rule is always pay taxes at the lowest rates. You'll always have more later on. You got to plan with the end in mind. When you're doing planning, forget about, I know we've talked about this on another show, when people say, well, what about the Medicare premiums? And you always say, oh, that's a rounding error. You're thinking short term. That's small potatoes. Look where you want to end up. It's insignificant in the grand scheme of things where you want to be when it counts in retirement or for your beneficiaries. So this is the real plan, to bring these balances down before they get devastated by what I call the retirement savings tax time bomb.
I love it. And you're exactly right. I mean, so many people, whether it's clients, CPAs, advisors, they're thinking short term, right? They don't want to take that step that is a little bit it's not very intuitive of pay a little bit more now. And I think what you did there, Ed, and just even sharing the story about your friend is stories help people understand this idea or concept of don't waste these lower brackets. We have capacity in a 0% bracket or a 12% bracket, a 22, a 24. Even 24 is a fairly historical low level when you think about, how to start extracting this wealth out. And so sharing stories, I mean, so many times when I'm talking about this stuff to other advisors, Like they're like, well, what software are you using? What
Oh, God.
models are you showing? And listen, that stuff's good. Like our team does that behind the
Yeah.
scenes to get to the right recommendations, but that's not what clients want. I love what you were showing with your client earlier. You just sketched out your wisdom of do this,
Yeah,
do this,
right.
do this. Was there some some fancy software you were using to get that notepad of your notes on what you should do? You know, again,
My
that's
accounting
your wisdom.
paper, my original accounting paper. Yeah.
Exactly. So again, you got to get people to think long term. And again, this is where, when I talk to clients, I really try to focus the conversation around lifetime taxes, because I feel like when I
Right.
start with that word, when I talk about taxes, everybody thinks about what I'm going to owe or what I'm going to get
Right.
this year. They're in everything we do when we have conversations with clients, it's lifetime taxes. Even in our marketing, I was just talking to our marketing team earlier, and I caught something. They were revising one of our advisors' websites, and it just said around like tax planning or tax management. And I said, no. You have to put the word lifetime tax management, lifetime tax planning, because it gets people to think that this is a game of chess, 3, 4, 5 moves ahead. It's not just about what you owe or what your refund is this year.
Right. It's lifetime. That's the key to all of this. And that's why, like I told you before, I think on one of our shows, every year on April 15th, I get all these requests. Let's see NBC for interviews. What can people do now to save on their taxes? There's 2 days left before tax day. And I'll do the shows because it's good exposure. And I actually set them up. I say, here's what you can do. Ed, what can people do to save taxes now? And I said, here, you ready for it? Nothing. That already happened. Saving taxes, just like you said, Dave, lifelong thing. Look at the big picture. You got to stop thinking short term. And people think, well, if I don't pay taxes now, I'm saving money. No, you're costing yourself money if you look where you want to end up. I saw a bunch of things. I always follow what goes on, not because it's interesting at the Berkshire Capital annual meeting in Omaha, and this one was really historic because Warren Buffett said he's going to step down. But one of the things that one of his distinguishable qualities, he used this term, unwavering focus on the long term. That's what you have to do. Unwavering focus on the long term. He always said, I don't care what a stock costs now. I don't care if it went up or down this year, if their earnings for this year, I care. Will this be a solid move for 5, 10, or 20 years now? It's the same thing with tax planning. Where do you want to end up? You've got to think long term. And you won't be saving money if you don't pay tax on this IRA, because it's growing, building. All it's doing is like growing weeds in your garden. At some point, that money is going to be taxed. And I always tell people it's not if, but when. So if it's about when it's going to be taxed, then pay it while rates are, I believe, the lowest they will ever see in their lifetime right now.
Absolutely. So let's kind of talk about two other things as we come to a conclusion here. I mean, I think we gave a lot of good insight on why you need to invest in yourself as an advisor in these types of things that can bring tremendous value. And Ed, you've got a great platform for people to come in and do that. You do a 2-day workshop, you do the elite
we
group.
have one. You get this. This is our book from the last one we did. You walk away with a 400-page manual. You've been to these things. Me and my team of experts, Sarah, Andy, and Ian, go through 400 pages of great value-building ideas. And my favorite part about this 2-day, it usually happens after the first break of the first day. People come up and the most common comment is, I didn't know how much I didn't know. That's your competitive edge, because the average advisor who's not going to this, they don't know that they don't know. So they're dangerous. And that business is there for the taking.
Well, I mean, Ed, just to kind of focus on that point, you and I just did a webinar, 2-3 weeks ago for advisors. Yeah. I think we had over 1,000 advisors on it. You were gracious enough to have some of your technical team on it, answering questions live for sophisticated financial advisors. And in 50 minutes, we had over 160 questions that your team answered on different technical components of an IRA. And these aren't general consumers. These are financial advisors who do this for a living. So this stuff is insanely confusing, for some advisors, let alone the clients. But I think the one thing we've typically agreed upon when it comes to IRAs is deferring into an IRA. And you and I use the word deferring because it's not necessarily a deduction. Somebody's going to pay the piper at some point, but a deferral into an IRA is a really good thing and the right move for clients when they have large charitable intent, because we have QCDs. And I saw you just did an article, and I think it was in Investment News on QCDs or wealth management or one of them.
Yeah, one of them. I write for a lot of.
Yeah, I just saw that come
Might
out.
have been even in our own newsletter.
Right. Or, of course, you can leave the IRA to a charity and they don't have to pay tax on it. So if clients have that charitable intent, it can be a good deferral source to defer that income and then transfer that wealth on to charities, and they inherit it tax-free and all well and good. But for everybody else that needs to live on their retirement savings or wants to pass on what, as our friend Dave Buchwald would say, what's taken them a lifetime to accumulate, then maybe it's not the best place to be deferring and stashing your money into.
It's not like it's not the best place. It's the worst place now, thanks to Congress. But really, all Congress did is incentivize us to do the better planning we should have been doing all along. IRAs were always complicated to work with, but they had redeeming values in that long deferral, the stretch IRA, which is no more. So we stuck with it. Here's a good analogy. You may have heard it before, but maybe some people haven't. It's baseball season now. So let's say you have a baseball player and he's just the greatest. He hits home runs. Not only does he hit home runs all the time, this is a mythical person I'm making up. Not only does he hit home runs all the time, but he hits them every time you need them, always clutch. Bases loaded, he'll put him in, he'll hit a home run. World Series, put him in, he'll hit a home run. So for that reason, he's the greatest. But here's the thing about that guy. Nobody likes him. He's a pain in the neck. He's involved in every scandal. He's the worst person on earth. Nobody likes, but they stick with him because he can hit home runs. Now, if one day that guy shows up, he says, I can't hit home runs anymore. He's gone because they don't like him. They only kept him because he could hit home runs. That's an IRA. Yeah, we stuck with it. It had redeeming qualities. It was a pain in the neck to deal with, but it had the stretch IRA, the long deferral. So we stuck with it. Now there is none. That's gone. There are no more redeeming tax qualities to this account. So I would say, not only like we've talked about, reduce these balances, stop adding to them. Why on earth anybody does a 401k? And when I say, I'm not saying don't add on to your retirement account. Don't add on to tax-deferred retirement accounts like 401ks or IRAs. Instead, Roth 401ks, most companies have them, and Roth IRAs. I say don't contribute to 401ks anymore. And what do you think all the advisors in the room, it's like, I broke the whole place up, I broke it, I changed everything about them. So somebody will yell out and they say, but Ed, the deduction, they people, again, and this is after I went through the whole thing of the big picture planning. And I looked at this one guy recently at a big program. I said, it's not a real deduction. And I coined this term. It's a fake deduction. It's a fake deduction because you have to give it back. To me, a real deduction, it's not even a deduction. It's an exclusion from income. But anyway, a real deduction to me is like you deduct home mortgage interest. You get that benefit, you keep it. Charitable contributions, you get the benefit, you keep it if you itemize. With this, all you're doing on the so-called deduction, all it is a loan you're taking from the government to be paid back at the worst possible time in retirement when you don't even know how high rates will go. So you're just adding gasoline to the fire. And then other advisors will say, but Ed, you're saying don't put into a 401k. What about the match? The laws have changed on that. You got to keep up with things. The match can go to the Roth 401k now. That has changed. So you have to think bigger picture. Don't exactly what you said, Dave. Yeah, look at saving lifetime taxes, not little breaks like you say, rounding errors and things. Look at little breaks to save taxes now if you have to give it all back later and then some.
Well, and this, just happened to me about 3 months ago. I'm in this entrepreneurs forum here in Charleston, and another business owner came into the forum and he was like, my advisor just told me about the greatest thing I've heard in a long time. I could set up this solo 401k and a cash balance plan, and I can get a deduction of, two or $300,000 of my income. And I had to explain to him, I said, listen, that's not a deduction, it's a deferral. And this particular guy was also eligible for qualified business income deduction. And I said, why in the world would you defer all that tax when right now the IRS is going to tax you on 80 cents on the dollar because of the QBI deduction that your business gets, to put that into a tax deferred retirement account where that's going to grow. And when you take it out, you're going to pay 100% of the tax liability. And again, just getting people to reframe that this isn't a tax savings that you're going to get to keep forever. It's a trade-off. You're going to get a little money in your pocket today by excluding some of the income, but somebody's going to have to pay that. And if tax rates are higher, or you build more wealth and you're in a higher tax rate, or your kids are successful and they're in a higher tax rate, somebody's going to pay the piper. So here's where I want to tee you up for this as we close out here. We've talked about kind of timestamps and where we're at, a lot of potential tax law chatter getting passed. And, you shared with us when we opened, you've lived through 40 plus years of tax changes or policies getting proposed. One of the things that's filling the news feed up right now is that President Trump is saying he's trying to eliminate taxes for people under 150,000 or 200,000 of income. If that were to ever happen, if a client came into my office today and said, well, Dave, why wouldn't I want to put money in the IRA? What if taxes go away for people like that? Is there any kind of thought pattern to that? Or is that just like, it's so far-fetched, it's not going to be able to happen?
That is never going to happen. Again, I have to bring you back to something I learned about many years, math, general math. The whole country is in debt, running on a credit card. They need revenue. And here's the secret to that. By the way, I do get some pushback, especially like from consumers. I do a lot of consumer programs, and when I talk all about the Roth, they say, but Ed, can I trust the government to keep its word that Roth IRAs will always be tax-free? And I always say, no, you can't trust them to do anything. As an old CPA saying, tax laws are written in pencil. But I'm going to tell you a secret about Congress. Lucky for us, and we should all be taking advantage of it as advisors for our client, Congress are the worst financial planners on earth because they are short-sighted. So why am I telling you that? Because here's the big secret. I don't even want to say it too loud, just between me, you, and a billion followers, okay? Congress loves, addicted to loves Roth IRAs. They're not going anywhere. You know why? Because lucky for us, they're such short-term thinkers. They look at the revenue that Roth brings in short-term. If you look at an actual tax bill, the actual wording, you see, especially Secure 2.0, if you look at the actual tax bill, the Roth provisions are at the end under a giant big font title called Revenue Provisions. That's how Congress looks at the Roth, as the revenue to pay for everything else, because they learned this back in 2010. Before 2010, this, Dave, but you couldn't even convert to a Roth if your income exceeded $100,000. Well, they eliminated that, and they got this boatload of money in, and they said, whoa. Let's do that again. It brings in revenue. And then they expanded over time, Roth 401ks, and more people can do that. And then they really tipped their hand in Secure 2.0. Now they want Roth, I call it Rothomania. They have Roth SEP IRAs, Roth Simple IRAs, 529 to Roth IRAs, Roth matching, Roth catch-up contributions. They want everything in the Roth because it brings in money, because the only money that can get into a Roth IRA is already taxed money. So let's take advantage of their short-sightedness. They don't realize if everybody did a Roth, or they don't care, they kick the can down the road, that nobody will ever be paying taxes in the future. but they want the revenue now. So they look at it as the golden goose. So they might trim around the edges, but they're not going to kill the golden goose that brings them all their revenue to pay for everything else.
Well, you give us a lot to think about, Ed. Your website, irahelp.com, if any advisors want to check out some of Ed's resources, their upcoming events. Like I said, there's the 2-day, and then also the elite group. And Ed, we appreciate you as always. I will see you next week in Atlanta. Thanks, Ed. We'll see you soon.
All right, Dave, thanks.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable, but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.